exchange ratio between them and comparing their prices. So money helps to compare different types of commodities and say which is costlier, which is cheaper, and what is the comparative value, and so on. Okay, they can be used to compare their prices. Then secondary functions of money. So in primary functions, we have seen two. Secondary functions, we have three. Total five functions of money. Secondary functions, one, standard of deferred payments. Yesterday, I had mentioned the meaning of the word deferred. Defer means postpone. Okay, instead of today, you make the payment tomorrow. So money also helps in deferred payments, postponed payments. It means that money acts as a standard for payments which are to be made in the future, not today, but in the future. Every day, millions of transactions take place in which payments are not made immediately. Okay, usually the transactions take place on credit basis. Okay, suppose you are a shopkeeper, you have fertilizer shop, then you purchase the fertilizers on credit basis. Okay, the dealer, maybe the dealer in Bangalore, he will supply the fertilizers, and you can make the payment after say 15 days or 1 month, need not be immediately. Okay, so for that, millions of transactions take place in which payments are not made immediately. Money encourages such transactions and helps in capital formation and economic development of the economy. So in the economy, everything cannot be done uh, on the spot, immediately make the payment, take the goods. No, it is not possible. Okay, so credit is part of the economic development process. So this deferred payments will help in capital formation as well as economic development of the country. It has simplified the borrowing and lending operations and has led to the creation of financial institutions. Because of money, borrowing and lending is possible. It has become easier. And the financial institutions, banks, then insurance companies, and so on, these financial institutions have been created mainly because of the invention of money. Okay. Then secondary function of money is store of value. So you can store the value of your assets in the form of money. Asset function of money, also known as store of value. Money can be used to transfer purchasing power from present to future. Uh, you can store the value in terms of money. Okay, you can say 1 lakh rupees, 5 lakh rupees, or 10 lakh rupees, and you keep that money with you, and it will have value in the future also. So money can be used to transfer purchasing power. With money, you can purchase other commodities. So money has the purchasing power. It can command over the goods and services. Okay, so that purchasing power can be transferred from today to the future because of the existence of money. Money is a way to store wealth that we know. Although wealth can be stored in other forms also, you can store in the form of maybe the commodities, maybe gold, and so on. Although wealth can be stored in other forms also, but money is the most economical and convenient way. It is very easy to store the value in terms of money because you can store lakhs of rupees worth, crores of rupees worth in terms of money. Money is easily portable. Portable means you can transfer, you can carry. Okay, so you want to go to, say, Mumbai, you can take money with you. Money is easily portable. Suppose all your wealth, okay, the entire wealth is in the form of sheep, ಕುರಿಗಳ ರೂಪದಲ್ಲಿದೆ ಅಂತ ಇಟ್ಕೊಳ್ಳಿ. ನಿಮ್ಮ ಹತ್ರ ಇರೋ ಎಲ್ಲ ಮೌಲ್ಯ ಏನಿದೆ, ಏನು ಸಂಪತ್ತೇನಿದೆ, ಅದೆಲ್ಲ ಕುರಿಗಳ ರೂಪದಲ್ಲಿದೆ. Can you carry all the sheep wherever you go, or goats or cows wherever you go? It is not possible. So money is easily portable. So it is easy and economical to store money as its storage does not require much space. Okay, so storing your wealth in the form of cows, storing the wealth in the form of grains, storing the wealth in the form of fruits or vegetables, it takes a lot of space. But storing wealth in terms of money, it requires less space. Okay. Then the third secondary function of money is transfer of value. Okay, you can transfer money from one place to other place. Say you are having some transaction with a person who is there in Kolkata or maybe in Assam. Okay, now person in Assam, he has tea, and you in Bangalore, you have, say, rice, and you would like to transfer rice to Assam and maybe purchase tea from him. But the problem is, the person in Assam, he is ready to sell the tea. But suppose you have to transfer rice to Assam to get tea, how much time, how much space, how much energy is required to transfer so much of rice to Assam? So it is difficult. Instead of that, you can transfer the value of tea in terms of money. Just mail transfer, maybe bank account transfer, or you send a check, or you send a DD. It is easier to transfer. Okay, so transfer of value. Money also functions as a means of transferring value. Through money, value can be easily and quickly transferred from one place to another because money is acceptable everywhere and to all. Example, it is easier to transfer 1 lakh rupees through bank demand draft DD from Amarinder in Amritsar to Bhaskar in Bangalore. Okay, so instead of sending wheat as such, you can send the DD. It is easier. Okay. Than sending the same value in terms of wheat. Instead of sending 5,000 kgs of wheat, you can just send 1 lakh rupees in the form of a GD. Then coming to classification of money. One is actual money. Actual money, according to James Keynes, okay, the father of modern economics, James Keynes, theory of employment. Okay, so he's famously known for that, and dig trenches and fill them up to overcome the problem of economic depression during the 1930s. So he's credited with so many uh, achievements. Okay, according to J.M. Keynes, actual money is that money which actually circulates and is current in practice in a country. Okay, the 200 rupees notes we have, 500 rupees notes, 2000 rupees notes we have, they're all actual money that is used, practiced. Okay, at present it is in circulation in the economy. Actual money is the medium of exchange of goods and services in the country. Okay. Then money of account. Of account, it need not be in circulation. Okay. You may not be using it in your accounts, but I mean, generally in the economy. But for your own purpose, you can use that money for accounting, but not in general, not in the economy as a whole. Okay, a monetary unit in which accounts are kept and that may or may not denominations. Okay, now our actual current denominations are 10 rupees notes, 20 rupees notes, 50 rupees notes, 100 rupees, 200 rupees, 500 rupees, and 2000 rupees. Okay, these are the actual current denominations. But in some countries, they use another monetary unit which doesn't correspond to, which is not related to the actual money in circulation. Okay. Now, for example, in America, there is one monetary unit called mills. Mills is a monetary unit, but it is not the actual money. Only for account purpose, not everyone, some industries, some people use it. 1 US mill is equal to 1,000th of a dollar. If you divide $1 into 1,000 parts, okay, one part is equal to 1 US mills. Okay, it is purely for accounting purpose, but it is not used in general. Okay. Then the third one is commodity money. It is a commodity that has intrinsic value. Intrinsic value means even if it is not used as money, it has its own value. Okay. Intrinsic value means that the commodity has value even if it is not used as money. Say gold, silver, and so on. Okay. Commodity money. Then legal tender. Legal tender. Legal means according to law. Legal tender is that money which even the court of law, Nyayanga, okay, court of law, it accepts for the payment. Okay, even the court of law says if this is used to make the payment, yes, it has to be accepted. That is legal tender. So it is that money which every individual is bound to accept. If somebody gives you that money, you have to accept it. Every individual is bound to accept in exchange for commodities and services and repayment of debts. So whether it is for purchasing goods, purchasing services, or repaying the loans, that money has to be accepted. That is, which is backed up by the government. Okay, so that is the legal tender. ಅವಸರ ಮಾಡಬೇಡಿ. ಯಾರಿದು ಭಾನುಕುಮಾರ್. ಓಕೆ, ನಾನು ಕಂಪ್ಲೀಟ್ ಮಾಡಿದ ಮೇಲೆ ನಾನು ಅದಕ್ಕೆ ಉದಾಹರಣೆ ಕೊಡದೇ ಇದ್ರೆ then you can ask me. Okay, there are two types there. Legal tender, there are two types. One is limited legal tender money and unlimited legal tender money. Okay, legal tender money is that money which no person can be forced to accept beyond a certain maximum limit. Okay, limited. So to a limited extent, a person can accept it. Say for example, Bhanu Kumar has to pay 1 lakh rupees to Divakara BP. Okay, Bhanu Kumar has to make payment of 1 lakh rupees to Divakara BP. Suppose he brings the entire 1 lakh rupees in one rupee coins. Okay, entire 1 lakh rupees in 1 rupee coins. Then Divakar may say, I refuse to accept it. But it is legal money. Okay, it is legal money, but limited. Okay, it is limited legal tender money. So it is that money which no person can be forced to accept beyond a certain maximum limit. The maximum limit is fixed by the government under statute. In our country, coins, okay, coins of small denominations, 1 rupees, 2 rupees, and so on. Okay, coins of small denominations are limited legal tender money. So I have to pay 10 lakh rupees, so I'll bring everything in 1 rupee coins. No, the other person need not accept it. Okay, then the second type is unlimited legal tender money. That means suppose that money is given, you are bound to accept it. You are forced to accept it. Okay, so is that money which a person has to accept up to any limit. Paper notes, your 10 rupees, 100 rupees, 2000 rupees, 500 rupees. These paper notes of all denominations are unlimited legal tender money. Okay, so I think Bhanu Kumar got the answer. Example for legal tender money. So it can be limited legal tender, it can be unlimited legal tender. All the currency notes are unlimited legal tender. Small denomination coins are limited legal tender money. Okay. Then representative money. Okay. It represents the actual money. Representative money, a type of money that has face value greater than its value as material substance. Bank checks, gold certificates. Okay, gold certificates. You have 10 lakh rupees worth of gold deposited in with the government. Okay, you have the certificate. The certificate as such, it doesn't have value. Okay, it is only piece of paper, but it represents so much worth of gold. It is representative money. Okay, then optional money or non-legal tender money. Optional or non-legal tender money, it refers to that form of money which is generally accepted, but legally one is not bound to accept it. Generally everyone accepts it, but legally you cannot force. Okay, for example, checks, bank drafts, etc. But generally it is accepted, but do not have legal backing, and their acceptance is totally optional. Okay, as a person you can accept it, or you may say, no, I want cash, I don't want check, I want cash. Many times it happens. Okay, when you go for purchasing, and if you say, I'll issue the check, the shopkeeper may say, no checks, please give me cash. Okay, optional money or non-legal tender money. Metallic money, coins. Collectively, the coins are called the metallic money. So, or you can also call as coinage, mintage, specie. They all mean the metallic money. Okay. Then near money, or sometimes it is also referred to as quasi money. Near money or quasi money, it means highly liquid assets that can be easily converted into cash. Okay. For example, savings accounts. You have money in savings accounts. Do you have it now? No, but easily you can convert that into cash. Just draw a check, issue the check to the bank, take the money. You can convert your savings account into cash. Similarly, term deposits, foreign currency, many a times the travelers, your relatives or friends, they go to other countries, and when they return, they will be having the currency notes of those countries. They can be easily converted to your currencies. Okay, foreign currencies which are widely traded. Okay. Then paper money, money in the form of bank notes that we usually use in our day-to-day life. Paper money. Credit money, it is any claim against a physical or legal person that can be used for the purchase of goods and services. Your credit cards, okay? So credit card loans and so on. You use the credit cards, debit cards and so on, okay? That is the credit money. Money supply, legal tender. I mentioned earlier, the national currency is legal tender in every country. Okay, the national currency, the notes issued by a government or the central bank of a country is the legal tender in every country. Okay, Indian rupees is legal tender in India, but Indian rupees need not be a legal tender in America or Switzerland somewhere. Okay, but in our country it is legal tender. Demand deposits. Okay, how the money supply occurs. One is legal tender, the notes printed by the government or the central bank, Reserve Bank of India. Okay. Demand deposits, it is an account with a bank or other financial institution. Okay, it may be in, maybe even in the post office. Okay, you may open an demand deposit account. You may open a savings bank account. It is an account with a bank or other financial institution that allows the depositor to withdraw his or her funds from the account at any time. So that is demand deposit. Demand deposit means you can keep your money in any financial institution and you can take out that money, you can withdraw that money at any time. Of course, during the office hours, but any day, any time during the office hours, you can take back that money. That is demand deposit. So on the other side, we have the term deposit, which you cannot take back anytime you want. Okay, the time deposits or the term deposit, it is a money deposit at a banking institution that cannot be withdrawn for a specific term or period of time. Once you keep it for 6 months, okay, suppose you deposit money in a bank under time deposits or under term deposit, okay, the duration may be 6 months or 1 year or maybe 1.5 years, 2 years, and so on. So if you make the deposit for 1.5 years, you cannot withdraw money for 1.5 years unless a penalty is paid. Okay, suppose the interest rate paid on the time deposit for 1.5 years is 6%. Suppose it is 6%. And you want to take back that money, withdraw that money within 6 months, then you will not get 6% interest on that. Okay, the interest, sorry, the interest rate will be reduced. That is a penalty. ನಿಮಗೆ ಅದು ದಂಡ. ನೀವು ಇಟ್ಟಿರೋ ಅವಧಿಗಿಂತ ಮುಂಚೆನೆ ನೀವು ಹಣವನ್ನ ವಾಪಸ್ ಪಡಿಲಿಕ್ಕೆ ಪ್ರಯತ್ನ ಪಟ್ಟರೆ ಅವಾಗ ನಿಮಗೆ ಸ್ವಲ್ಪ ದಂಡ ಬೀಳುತ್ತೆ. ಓಕೆ, ದ ಪೆನಾಲ್ಟಿ ವುಡ್ ಬಿ financial assets with non-banking intermediaries. Okay, there are some non-banking intermediaries like provident funds, pension funds, small savings organizations, life insurance corporation, general insurance corporation, unit trust of India, mutual funds, chit funds, housing and urban development corporation, HUDCO, then housing development finance corporation. These are all non-banking intermediaries. They don't deal with the regular banking activities, but financial assets, yes, they all deal with. They're all sources of money supply. Then treasury bills. Treasury bills are the government bonds, okay, with maturity of less than a year. Government wants money, okay, it may sell bonds. Sorry. Government wants money, say for a period of 6 months or 9 months or so, okay, then the government may sell some bonds to say banks. Okay, banks purchase the bonds from the government and makes payment to the government. Government uses that money for some developmental activities in the country or in the state. And by the end of the period, so 6 months or 9 months, government pays back the money to the bank. So treasury bills. These are government bonds with maturity of less than a year. Then bills of exchange. I think yesterday I explained this. A bill of exchange is an agreement by one party to a fixed amount of cash to another party on a predetermined date or on demand. Usually this is followed in case of international trade, exports and imports. Bills of exchange are primarily used in international trade. And I also mentioned that suppose you have sold the commodity and the payment will be received after 1 month, but you need the cash immediately, then the bank will help you. So they will make the payment to you and you have to give that bill to the bank. Bank will collect from the purchaser of commodity from you after 1 month. Okay, bills of exchange. Then bonds. Okay, a bond is a debt investment in which an investor loans money to a company. Okay. Suppose you have some money with you, some 50,000 rupees, and you don't want to keep that money in the bank because the rate of interest paid by the bank is very less. Earlier, they used to give 10% interest if you keep the money in fixed deposit for 5 years. but today it has come down to 6% or so. So it is not attractive. Okay, the interest paid by the bank is not attractive, so you don't want to keep the money in a bank. Instead of that, you want to invest money in a company. Okay, there are two types there. One is in the form of shares. You can invest money in a company in the form of shares, or you can invest money in a company in the form of debentures. Debentures are also sometimes called as bonds. Okay, when you invest in shares, when you purchase shares from a company, you will become one of the owners of the company. Okay, suppose uh, a company sells 100 shares. It will sell shares in thousands. Okay, but just to understand the principle, a company sells 100 shares. Okay, now I see the name here, Gautami. Okay, 0071. Gautami purchases 10 shares. Okay, a company sells 100 shares and Gautami purchases 10 shares. Then she becomes one of the owners of the company. Not the only owner, one of the owners of the company. And what is her stake in the company? 1/10. Because out of 100 shares, she has purchased 10 shares, so 1/10. Okay, so her stake in the company, her ownership in the company is to an extent of 1/10 of the total value of the company. Okay, so that is share. You will become one of the owners. But the other form is of investment is the debenture or the bond. Usually, in general, it is called as debenture, but when it is issued by a government, it is called bond. But otherwise, usually they mean the same, bond and debentures. Okay. Suppose you purchase a bond, then you will not become the owner of the company, but you will become one of the creditors of the company. Okay, one of the creditors of the company. You are a person who has given loan to the company. ಆ ಕಂಪನಿಗೆ ಸಾಲ ಕೊಟ್ಟಂತಹ ನೀವು ಒಬ್ಬ ಬಂಡವಾಳಶಾಹಿ. Okay, so you are a capitalist who has given loan to the company, bond. Okay, the thing is, shareholders, the advantage of being a shareholder is, if the company makes huge profit, if the company is flourishing, it is doing very well, it is earning huge profit, then you will get a larger share in the form of dividend. Labhamsha nimige tumba baratte, you will get a lot of money. But if you are a bond holder, if you have invested in bond, then the interest rate, because it is a loan that you have given to the company, the interest rate is always fixed. Suppose the interest rate fixed is 15%. Whether the company makes 1 crore rupees profit or 10 crore rupees profit or 100 crores rupees profit, you will get only 15% on the investment you have made. Suppose each bond is worth 100 rupees. The value of each bond is 100 rupees. Then interest rate is 15%. You will get only 15 rupees as the interest for 100 rupees. But if you are a shareholder, okay, then if the company makes huge profit, though you have invested only 100 rupees, you may get 1,000 rupees share in the profit. It is possible. Okay, so that is the difference. Bonds or governmental organization which borrows the funds for a defined period, as I mentioned earlier. If the government wants money, okay, it sells bonds. Some time back, the Karnataka government, it wanted more money for the Upper Krishna project. To complete the Upper Krishna project, that is construction of dam and canals across Krishna River in North Karnataka, they wanted money, so they sold the bonds. Okay, they sold the bonds to raise money, to collect money from the public, to use it to complete the Upper Krishna project. Okay, borrows the funds for a defined period of time at a variable or fixed interest rate. Okay, bonds are used by companies. Okay, now other thing, usually those who are conservative, those who are not ready to take a risk, they invest in debentures or they invest in bonds. Those who are risky type, those who are ready to take more risk, they invest money in shares, because shares, they have the last preference. Bonds, debentures, they have the first preference. Like suppose you conduct some puja or some function at home, ನಿಮ್ಮ ಮನೆಯಲ್ಲಿ ಏನೋ ಒಂದು ಕಾರ್ಯಕ್ರಮ ಇಟ್ಕೊಂಡಿದ್ದೀರಿ. Okay, for that you invite your friends, relatives, okay, your office persons, colleagues, friends, and classmates, and so on. You invite them. When they come to your house for that function, for the lunch, do you first eat and then ask your friends to eat? No, never. What you will do is, first you will serve food to your distant relatives, your office colleagues, and so on. Then your close relatives, and finally you, your wife, brother, you sit, children, you sit together and eat. Very similarly, the bond owners, okay, the bond holders, they will get first preference, and the shareholders, they will get the last preference. So bonds are used by companies, municipalities, states, and sovereign governments to raise money and finance a variety of projects and activities, as I mentioned earlier. Equities are the shares. Okay, equities means shares, bonds are debentures. Investment made by shareholders in a company. How does variable interest is determined? It depends on the market rates, fluctuations in the market rates. Okay, so even when you take a house building loan, okay, housing loan, sometimes if you accept, it will be variable or it will be fixed. Okay, if it is variable, if the interest rate in the market changes, RBI changes the interest rates to control inflation and so on, then the banks also change the interest rate. There will be variation in the interest rate in the market. Okay, that is variable interest rate. Then there is one more classification of money: M0 money, M1 money, M2, M3, M4 money. M0, M1, M2, M3, M4, and M4 money. Okay, now we'll look into each one of them. What is M0 money? The components of M0 money is, it is the currency in circulation. Okay, so all the notes, all the coins that are in circulation in the economy, in the country, it comes under M0 money, currency in circulation. Bankers deposits with RBI. All the banks, they deposit money with the Reserve Bank of India. Okay, that is also part of M0 money. Other deposits with the RBI, other than banks, any organization, the government, okay, it deposits money with RBI. They all come under M0 money, and total M0 money, combining all these three, it is also referred to as reserve money, monetary base money, high powered money, monetary base of the economy, You can call it by any name. It is M0 money. So currency in circulation, bankers deposits with RBI and other deposits with RBI put together is M0 money. Then M1 money. Components are currency with public. Okay, here we don't talk about currency in the economy. We talk about only the public. Okay, people. Currency with public. Demand deposit in all banks. What is demand deposit? The money which you can withdraw, money which you can take back anytime. That is demand deposit in all banks. Your savings accounts, your current accounts, and so on. Other deposits with RBI. Sorry. So these three together is called as M1 money. Okay, currency with public, demand deposit in all banks, and other deposits with RBI together is called as M1 money. Then M2 money. M2 money is M1 money plus post office bank savings. Okay, savings made by people in post office accounts. Okay, now here the star mark, similar to regular banks, post office also offers time deposits, recurring deposits account, time deposit account, and so on. But when we say post office bank savings, here we count the post office savings only. So time deposits in the post office is not included. It is only the savings bank. Okay, so M2 money is nothing but M1 money plus post office savings amount, savings account amount. Okay, then M3 money, or also referred to as broad money. Another name for M3 money is money aggregate. The components of M3 money are M1 plus time deposits with commercial banks. Okay, fixed deposits, recurring deposits in the bank, commercial banks. Remember, M3 money is equal to M1 money plus time deposits, but it is not equal to, M3 is not equal to M2 plus time deposits. It is only M1 plus time deposits. Okay, that is M3 money. And finally, the M4 money, it is M3 plus total post office deposits. So time deposits, recurring deposits, everything put together, M3 plus total post office deposits. But it excludes national savings certificates, etc. So here we talk about only the accounts like savings bank account and fixed deposit account and so on. Only the money in the accounts, not the certificates, national savings certificates. Usually people deposit money in the post office in the form of national savings certificates. That means they purchase the national savings certificates earlier. All of us, we used to purchase the NSC. We used to call it as NSC, National Savings Certificate, NSC. We used to purchase NSC mainly to reduce the burden of income tax. Okay, so if you purchase NSC, on the amount invested in NSC, we used to get reduction, rebate in the income tax. But these days, since our income has gone much beyond that, after all these pay commissions, the teachers' income has gone much higher. So NSC is not that attractive, but still people purchase it. National savings certificates, earlier the rate of interest was around 14%. So within 5 years, in 5 years, not within, in 5 years time period, the money that we invest in national savings certificate used to get doubled. If you purchase 1000 rupees worth of national savings certificate, in 5 years it used to become 2000 rupees. But now everywhere the interest rates have been slashed, interest rates have been reduced. National savings certificates, yes, people still invest in that, but it is not included in your M4 money. So liquidity and ranking. Liquidity is how easily you can convert that into the money, cash, okay, hard cash. So M1 money, narrow money, it is a narrow money type, highest liquidity. Okay, that means easily it will be available in the form of cash. M2 money, also a sort of narrow money, liquidity less than that of M1. M3 money, also referred to as broad money, liquidity is something less than M2. Broad money, M4, it is the lowest liquidity. Okay, so it takes some effort to convert that into cash. But M1 money, it is easily converted into cash, very easily, or almost it is in the form of cash. So this is in brief about classification of money. Okay. I'll talk about the general price index. General price index is the index numbers which are worked out periodically to measure the rate of inflation in the economy. ನಾವು ಹಣದುಬ್ಬರ ಬಗ್ಗೆ ಮಾತಾಡ್ತೀವಿ. Okay, ಹಣದುಬ್ಬರ ಬಗ್ಗೆ ಮಾತಾಡ್ತೀವಿ. We also talk about cost of living. Okay, cost of living has gone up. Nowadays, it is very difficult for common man to live. It is very difficult to make the two ends meet for a common man. So we hear all these statements. Okay, so it is related. Yeah, term deposit, fixed deposit, they are the same. Okay, they're the same. So these price indices are used to measure the rate of inflation. Okay, now how these price index are worked out? Usually what they do is they take a representative basket of goods and services. Say the staple food items, rice, wheat, then some important fruits, vegetables, milk, cloth, your school fees, okay, and all those things. A representative basket of goods and services, and they select one particular year as the base year. That base year would be a normal year. In that year, there should not be severe drought. 2020, 2021 cannot be a normal year because of Corona pandemic, COVID pandemic. Okay, 2020 not a normal year, 2021 not a normal year, 2019 was not a normal year because there was general election in the country. So there should not be general election. There should not be war. Okay, if there is war between India and neighboring countries, that year cannot be normal year. So a year which is normal in all respects is taken as a base year, and the prices of all the goods that are included in the basket, okay, is taken as 100. Okay, so the price of all the goods in the basket during that base year is taken as 100. Then in the subsequent years, how the index number changes. Suppose base year was 2018, 2019 it became 104. Then there is 4% inflation. Okay, this is how they do it. Not as simple as I explained, but this is the basics. Okay, so general price index, it is a measure of change in the general level of prices of goods and services. I repeat, it is a measure of change in the general level of prices. That is your inflation. Okay, change in the general level of prices of goods and services. The general indices, okay, assess the change in the purchasing power of the rupee. If the prices of all the goods and commodities increase, then the purchasing power of rupee comes down. Okay, as the goods become costlier and costlier, the purchasing power of our currency, purchasing power of our rupee goes on decreasing. Okay, this index often measures the inflation in a market that increases prices for goods and services at both the wholesale and the consumer level. Wholesale ಸಗಟು ವ್ಯಾಪಾರ ಮಟ್ಟದಲ್ಲಿ, consumer level the retail outlets. Okay, it is the widely used general price index is the widely used indices of price changes. Okay, sorry, widely used indices of price changes are consumer price index, the abbreviation is CPI, and wholesale price index, WPI. Consumer price index, what the consumers pay at the retail level, and wholesale price index, what is the price of the commodities at the wholesale in the wholesale market. Okay, so earlier the inflation was measured, it was expressed based on WPI, but since 2014 it has been changed from wholesale price index to consumer price index. Okay, so consumer price index is a measure of changes in the price level of market basket of consumer goods and services purchased by households. So they work out what is the change in price in terms of index, okay, for all the goods and services that are purchased by a normal family. Okay, so it is worked out separately for rural people, separately for urban people, and so on. Okay, because the lifestyle will be different, the purchasing power will be different. Okay, so it is worked out separately. The CPI, Consumer Price Index, is a statistical estimate constructed, worked out using the prices of a sample of representative items whose prices are collected periodically, every week or every fortnightly, and so on, daily, sometimes daily, the prices. Inflation is measured using CPI. The percentage change in this index, as I mentioned earlier, base year, everything is taken as 100, and the change, percentage change in this index over a period of time gives the amount of inflation over that specified period. Base year 100, this year it is 108, then the rate of inflation is 8%. Okay. CPI indicates the cost of living. Okay, so if the consumer price index goes up, then cost of living has also gone up. So living has become costlier and costlier. Types: CPI rural, for rural people, consumer price index. CPI urban, so consumer price index for the urban people. CPI agriculture workers, so consumer price index for agricultural workers. And CPI industrial workers, so consumer price index for industrial workers, and so on. So it is not one figure for the entire population, because their lifestyles, their cost of living, and their income level, they all differ. So different types of consumer price index are worked out. And finally, the wholesale price index. It is a measure of change in the price of representative basket of the wholesale goods at the wholesale market level, not the retail market. Okay. WPI is used as an important measure of inflation in India, and all our government measures to control inflation, okay, fiscal and monetary policy changes are greatly influenced by changes in wholesale price index. Note, till 31st March 2014, wholesale price index was used to estimate inflation, but since April 2014, RBI uses consumer price index to estimate the inflation. So okay. What is, Ankita Verma, what is near money?
So you told that which can be accessed very easily, so which can be converted, which we can use it like that anytime we want.
Just a minute, I'll go back to that. So currency in circulation, which is there very readily available and so on. So M1 money, currency with the public, okay. So demand deposit in all the banks, which includes the current account as well as savings account. Okay.
Okay, sir.
It includes the current account also.
Okay, sir.
Okay. Are there any other questions? Through which inflation can be measured more accurately, CPI or wholesale price index? Now it has been accepted as consumer price index. Earlier they used to treat WPI as more realistic, but now they say CPI. Gavi Siddesh, sir, this one, sir, what is this one? I don't know, what is this one?
Sir, about mutual funds, sir. Difference between mutual funds and...
Yeah, that will take up in the next class, okay? What difference between mutual fund and?
Shares, sir.
Oh, no, there are different things, okay? Shares, mutual funds is only the deposit you make, okay? Which will be used for some other purposes, and you'll get returns on that mutual fund. But the shares are something different, which you invest in the companies which take up some other projects. Say, for example, Reliance. Okay, in the Reliance company, you make the investment in the shares. It is used for, say, production of some commodities, Reliance textiles and so on, or petroleum and so on. Okay, that is the one.
Sir, but in mutual funds, the large cap companies, they only hold the shares of different companies, no?
Yeah, that is there. But the thing is here, the way the money is invested and used, they're different.
So, but like in mutual fund, they show that you get this much percent of extra income from that particular investment you have done.
Yeah.
So, is it like surely that you would be getting the same percentage that they are showing?
Uh,
Like we do fixed deposit in SIP, na sir. That is it a same one or a different one?
I think there will be also a clause there. The terms and conditions apply.
Yeah, yeah,
Will
yeah.
it be there? Yeah.
Yes,
It would be there.
yes.
Okay. Thank you then.
Thank you,
Thank you.
sir.
Bye.